Welcome everyone to another episode of Kuvera Insights, where we talk to leading industry experts to learn more about how we should manage our money and grow our wealth. We have two very interesting guests today. You probably know about both of them. We have Hansi Mehrotra, who's a practicing CFA and the founder of The Money Hans, a personal finance education blog aimed at retail investors. She's also the founder and editor of Money Management India. Hansi has over 20 years of financial services industry experience in online delivery of investment research and consulting for the wealth management industry. She set up the wealth management business for Mercer's investment consulting business across Asia Pacific, and she helped design the investment options for NPS. So that's super interesting. Hansi is a Bachelor of Arts from Delhi University and a graduate diploma of applied finance and investments. She's been named top voice and power profile on LinkedIn. Welcome, Hansi.
Yeah.
We also have Jency Jacob with us, who's the managing editor of Boom. That's a Boom name. That's a good name. And he has worked with some of the top television and print networks in the country. Jency manages a newsroom of enterprising fact checkers who are striving to keep our social media and public space clear of misinformation and communally sensitive disinformation. So really he deals with misinformation, misselling, all kinds of misselling. Sometimes misselling need not be about lying. It can also be about omission. So I'm pretty sure he can kind of enlighten us about all the different kinds of misselling that happens in personal finance. Jency is a regular speaker at various national and international conferences and speaks about the importance of battling misinformation and the media's role in countering them with credible and factual news stories. Welcome, Jency.
Thanks, Gaurav.
So today we are talking about financial misselling. We are talking about all the different kinds of misselling, like I mentioned. Some of the missellings can be just about omission, where you are only shown the returns but never told the risks. You're not actually being lied to, but it's some kind of a misselling, but a lower end. And then there is blatant misselling, where a product is kind of represented to you in a way that is actually not beneficial to you, but it's represented in a way to you where it seems like it's the most beneficial product to you. So let's start with you, Hansi, right? Like the first thing that we want to kind of cover is the how and why of misselling. So why does this misselling happen, right? So there are two parties involved, of course. There is a consumer who has to buy that product, and there has to be an agent who has an incentive to sell this, right? Now the agent's picture is clearer, right? I mean, they get revenues by mis-selling, so they have that. What happens with the consumer? I mean, are the consumers really gullible here? Is there a greed and fear impact that can be played on, or is it purely that most of the mis-selling is just lying and pushing a product through?
Yeah. So as you said, there are two sides to it. On the distributor, agent, or salesman, whatever you want to call it, or advisor, depending on what license you have. It's as you said, incentives. But I also come across people who have the best interest, or they have their heart in the right place, but they themselves don't know any better. So I think it's a function of both their own training and education as well as incentives. Right. So yeah, that's that aspect on the salesman side. In fact, I actually have a family member who has been selling insurance agent. She's a retired bank manager, and she's been selling insurance policies, the typical LIC ones that I would never buy. But I know her heart is in the right place when she is selling it to her friends and family. So I'd say that also needs to be addressed. Now, putting that to one side, assuming that they themselves are not well trained, and they have the incentives to go and sell. They don't know that they're mis-selling, perhaps. Why does mis-selling happen on the other side? I think on the retail investor side, we just haven't been taught that when we were growing up. As simple as that. I think we were taught biology, so we have a basic idea of how our body works. We were taught a bunch of other things that may or may not have been useful in our day-to-day life, but we weren't taught the basics of finance. So I think on some level, we don't understand the very, very basic concepts. One. Two, even if we did, I think finance and economics are not, I don't think that. I mean, they're not hard sciences. So there is no right or wrong. There is no hard and fast. It's not like gravity that if you drop it, it will go down. So in finance, a lot of people say things like, "Oh, what has gone up will come down," and vice versa. No, it doesn't. Not necessarily. That's your belief in value investing, perhaps. So there's a bunch of things like that that are people's opinions, and and finance and economics generally is a human-made construct. So just because you look at the last 10 years, 20 years, even 30 years, or even 100 years, doesn't mean it will be so. In fact, all the surprises happen when they are new, right? That's how crises happen. So what I'm saying is, again, on the investor side, we don't know the basic concepts, and even if we do, there is no engineering or science type concept in finance. So the people who are misselling to us may themselves genuinely believe that this is about to happen, and we don't know any better.
I mean, this raises a very interesting point, and let me just delve one level deeper into this, right? So, and I completely agree with you, right? I mean, finance and economics are by definition probabilistic; they're not definitive sciences. So, but that creates a kind of that muddies the water. So, how do you categorize misselling then? Because if it's probabilistic, then unless you are blatantly misrepresenting the product, right? You're saying that the product does A when it does not do A. Pretty much everything you will say will have some probability of being true.
Correct. So then,
so what constitutes misselling in this kind of a framework?
I think the one concept that the regulators are aware of is obviously suitability, right? Is this product suitable to your circumstances? So that's one aspect, which is basically you shouldn't be selling an alternative or a high-risk product to a retiree, for example, or insurance to a retiree. So there's a suitability aspect, which I think has been relatively well defined. I also believe that financial products inherently are not good or bad. It's the price that you pay for them. Okay, so underlying asset classes, there are only two. There's only equity and there's debt. Everything else is a derivative of that. There's short term, which is called cash, there's medium term, there's fixed interest, there's high yield, there's junk bond, there's a whole bunch of things, right? Same thing with equity. Real estate is part of equity, then there are real assets, there are commodities, there's equities, and there's a very... So anyway, the point is, if you understand the basic concept, investments is about paying the appropriate price for it. What happens in the financial services industry, we take the underlying asset class, underlying businesses, underlying assets, whether it's real estate or commodities, we package them. Financial services packages the products. And in the process, we alter the risk-return outcome by either loading up with too high fees or putting in some other financial engineering in terms of options and futures that alters the payoff. And then, of course, when somebody's buying and selling, there are two different opinions, right? I might be buying, you might be selling, so we have different opinions on what their price is worth. So there is no such thing as the right price and therefore over or undervalued. Over undervaluation is somebody's opinion. The buyer and sellers have different opinion. So I believe there is no such thing as a bad product. I mean, I shouldn't say no such thing, but there's a very few inherently bad products. They have been made so with usually high fees and high commissions and some financial engineering that wasn't needed. So my advice to people is, if you don't understand, stick to the very, very basic and simple products. Buy businesses that you understand, buy assets like real estate or gold or whatever it is. You should have a diversified portfolio. There's nothing inherently good or bad. It's just the price you're paying for it. And you should have an idea of how much return they're capable of producing. So some basic education I believe in.
Understood. So between, so Jency, you can also chime in. What are the 2 or 3 most missold products in financial services? It doesn't have to be investing related, can be anything, but in your anecdotally, or if we have some data around it, what are those products that people have to watch out for?
Oh, well, I think Hansi has set the bar too high when she says that actually it's the price that is a problem. And partly I do agree with her. Also going back to the entire issue of literacy, right? I'm in the space of digital news, and we talk about misinformation and we bust misinformation on a very active basis. So just to take a step back, if you take the same definition ahead based on what Hansi has said, there is misinformation and there is disinformation. Misinformation is something that you don't know whether it is true or false. You just got it through someone, or if I take it in the investment space, someone tells me that this insurance product is good. I decide that I want to buy it. I go and buy it. Probably, it's worked for me for a few times, because I haven't really gone and checked the life cycle of the product or the mutual fund scheme. And I go and do it. And then I tell some 10 others that, you should also invest in this product. That's based on misinformation. If I stretch the definition a bit, disinformation is something different. Disinformation is more in the communal and the ideological and the religious and the political space, where I know it is wrong, but yet I go around spreading that myth just because it's part of my echo chamber and it's part of my belief system, and I believe that no matter what it is, this is what I'm going to believe in. If you take it into the financial ecosystem space, I don't think you have exactly the same replica, but those who have an incentive to sell, they will missell in some form or the other. I don't mean to say that everyone has an incentive, but people, genuinely, we are not trained to actually question those who tell us that, you will get this much returns or those many returns. Just think about it. Even today, you will find either your friend or your cousin or an elderly person who would have still put that money in a cooperative bank and have lost money. I mean, I just had a friend a few weeks back talking to me about it, and I asked him a very simple question: why did you put your hard-earned money in that bank? And it is a very local cooperative bank that you will not expect an educated person like him to put his money. And you know what his reply was? Just because, probably his parents were doing it in the past and they have always got a good return. And I kept on asking him, in an interest rate scenario where banks are giving you 4.9% or 5% on your fixed deposits, how on earth can anyone justify by giving you 8 or 9% returns? This is simple economics, or this is simple monetary policy that none of us are actually trained for.
That could just be risk mispricing, right? So your friend just mispriced the risk, but that does not necessarily mean that the cooperative bank missold him or misrepresented their product. I mean, what I'm saying is very simple. I am a very small bank. I have a huge need for assets, and I'm not defending the industry, but just for this particular point. And I can come in and say, hey, you know what, fixed deposits in my bank is 8%, but as long as I say that all the risks apply. But if I start saying, hey, you know what, the deposit is 8%, but it is as safe as a PSU bank, now that last statement is misselling. The first statement is just a statement of fact. We are giving 8% returns on an FD because we are. Now, it's if you come and ask us, are there risks involved? Then yes, our FDs will have to list all the risks involved in those. Most people will not read that. So I think sometimes there is that fine line between people mispricing risk, which is kind of where the thought comes that sometimes the customers themselves are gullible because they have this greed and fear working for them. Though, I mean, to also add something to what Hansi mentioned about price. My personal opinion is that it is more than just price. So what I have seen in real life, and many times, right, sometimes with myself as well, because the first time you meet a banker, they don't know that you're from the industry. And that's usually the best, conversations, because they think you're from the tech world. They don't know that I had been working at banks and blah, blah, blah before that, right? So, but I've seen that there is a framing game that everyone plays. When someone wants you to buy a product, right, they will not misrepresent the product, but they will only tell you the good things about that product. And they will wait for you to ask the counter questions. And if you are not, and this again, I think goes back to what Hansi also mentioned, if you don't have that level of financial education, you may not even know the right questions to ask. You will not ask the risk questions. So what will happen is you go to an insurance, and insurance, it doesn't have to be insurance, right? In 2018, you could go to a broker and they would be pushing small caps, and they would just show you 3 years of small cap returns.
Yeah.
But then the onus is on you to say, can I see the 10-year graph? Can I see the 20-year graph? Can I see how much these funds can also lose? But if you don't ask those questions, you look at the 3-year returns, you say, oh, 20% per year every year. My God, this is going to the moon in the next 10 years. Of course, it doesn't, right? So I think we do believe that some of that happens. But anyway, I just wanted to kind of draw the line between people mispricing risk themselves versus someone actually coming and misselling them a product?
Yeah, I agree on that front. I was just trying to draw the analogy to explain that people are not always rational when it comes to their money, and irrationality is where misselling happens. Right at the end of the day, someone is selling a product. Now, you may agree or you may disagree. There's nothing in the law which probably may prevent them from selling your product by not telling you certain things. Though I do believe that now there are distributor norms and there are ways in which you can be held accountable, though how much of that is possible, I'm not aware. But what I was trying to say is that when it comes to money, we are irrational. Most people are irrational, which is why you still see, even this year, you would have seen that post the pandemic, there is a huge rush of people trying to make money in the stock markets. Or there are people jumping into buying SIPs, or there are people trying to buy some product which they feel that the capital will be protected. Now, these are all ways in which it all draws back to the same thing, that we have not been taught how to manage our money, right, which goes back right into our education system, and that's why probably we end up making a lot of losses at times, and learn it the hard way. Only when you lose money do you know how you can make money.
Yeah.
So on the note, so I agree with you, Gaurav, about the mispricing being one. Jency, I know it's fashionable to say that we are irrational and we're driven by greed and fear. Of course, we're driven by greed and fear. Everyone is, but I don't think we're irrational. I think the textbooks got it wrong by calling or expecting us to be robots, calculating and doing a compounding calculation in our heads while we're going around. I mean, that is stupid. Okay, so I think the textbooks got it wrong, and now they're making us calling us irrational. No, I think we are normal. The textbooks were irrational to have come up with a theory that we could do our calculations in our head. No one can. Okay, and I work with actuaries. Trust me, even they get it wrong.
It's what the Thaler's and the behavioralist says, right? The
yeah,
textbook would want you to believe that you're Homo economicus, so
correct.
You can do all those differential or derivatives in your head, but no one, we're not econs.
I have a bunch of issues that I want to bring up here. One is one of our regulators is doing a good job, which is SEBI, in terms of suitability and stuff. But financial products don't just get sold by SEBI regulated people, right? So there's insurance products, there's chit funds, there's real estate, there's gold related. There's a whole bunch of financial products out there that are not regulated by the regulator that we want to regulate. So one, there's a whole regulatory arbitrage that's happening that I think needs to be looked at. We've touched about past performance. Okay, so I had this argument with the regulator in Australia about 20 years ago. People, regulators included, think that it's okay, it's better to show facts. So let's show past performance because it's a fact. But if I show the last 3 years past performance, as you said, which is like say 45% per annum, you are omitting the fact that I mean, I know you say the standard line, past performance is no guide to future performance. Everyone says it, no one believes it, right? So you are purposely leading people to believe that past performance is going to be repeated. So I put it to the regulator years ago, why not make the institution make a long-term forecast? So yes, this was a 45% return per annum compound, but what do you expect the small cap fund to perform in the future? And if they are as chief investment officer, they will not put their name to any higher than say 15% per annum, if that, right, in India, right? So what I'm saying is, I know it sounds counterintuitive, but presenting facts only is misleading. You need to also make someone do a forecast because finance is all about forecast. That's the second issue. So regulatory arbitrage, fact versus forecast. The third thing I want to say is this financial education bit. I don't know whether we'll get to it or not, so I'm raising it now. So yes, not only were we not taught financial education or financial literacy in school and colleges, but now there's this belief by some well-known journalists and commentators that financial education doesn't work. So a lot of people comment this as fashionable to say that, and they basically base it on meta studies of financial education sort of interventions without having done a randomized control trial. So they didn't do a test before and then they do the intervention, and then they do after. And also, you know, and I know, and everyone knows that a 1 hour intervention poorly designed by a non-financial, non-communication, and non-education expert. Okay, someone just done a 1 hour gyan in front of a whiteboard and then says, "Theek hai, I did a financial education intervention, and now you must be financially literate. And now if you buy something, either you're stupid or someone has missold you." No, that's not fair. You cannot have taught me everything I need to know in 1 hour. That's just not going to happen. So I believe that financial news makes it sound like you watch this one show and everything you need to know is covered in this show. No, it's not. Like any other subject, there is a wide variety of concepts that you need to understand. And therefore, I believe, and this is why the Money Hunts is my free initiative. I have no ads on it. I don't charge anything on it. I have no products to sell. I have nothing to sell. I'm just doing this because I feel so passionate about this. And here's what I'm saying. There are concepts, there are mental models you need to understand. You need to understand how the economy works. You need to understand how financial services works. You need to understand how equity markets work. The basic concepts that everyone needs to understand. And then once you have a mental model, then any information that is thrown at you via a well-meaning program or intervention or a podcast like this, then you can see how this information, this new information that you've just learned, fits into that mental model. But if you don't have any concept, any idea of how the world works, how do you know what to do with that information?
But that imposes, I mean, most of it I agree with, but the only thing is that, that imposes a very high degree of learnability on the end users and almost puts all the onus of not being missold on the end user. Is there a, I mean, some of the things that we think about quite often is, are there regulatory ways to be able to do this? Are there low-hanging fruits by which you can do this, right?
Yes. Yes.
Instead
the
of
simplest one is record it. Make it in writing. So when I get a call, every time I get a call, I scream at them saying, "Don't you dare do a verbal conversation." Okay, I'm recording this call. I'm telling you I'm recording. In fact, 2 weeks ago, I got a call from someone and I said, "I'm recording this call." Actually, I said it at the end of the conversation rather than the beginning because I obviously wanted them to say whatever they wanted to say.
Right.
And sure enough, it was a misselling. It was them misselling a portfolio of ETFs or a portfolio, a basket of pharmaceutical stocks. They're saying, hold this thing, keep it for a month and a half, and you will get amazing returns. Right. And then I told them, hang on, dude, I mean, I asked this woman how long she was a finance expert. And she said, oh, I've only had this job for a month and a half. I'm not a finance expert. I'm obviously reading off a script. So
that's something we 100% agree with.
We need both. I think we need, I'm not saying put the onus on the user. I'm saying basic concept, the user also. It's like when you run the traffic lights, do you say, I didn't know the law? I mean, it was on the onus was on the government to tell me that the red light means don't walk. I mean, no, it's some you can't claim ignorance of the law, right? Similarly, what I'm saying to you is some basic understanding of how the world works is the onus has to be on you. It's your money. It's like that ad now that Alec Vidamsi had come up with, Marzi hai aapki, sar hai aapka. Right? That ad about helmet. Not wearing a helmet. So people think the helmet is to prevent being booked by the havaldar. No, the helmet is for your own protection. Right? Similarly, I'm saying to you, if someone is giving you information, you need to read it, you need to understand it. It's for your own protection. Yes, we will also work on the regulator and on the industry and self-regulation and a whole bunch of other things so that people don't missell and we catch them in case they missell by recording and insisting on writing and a whole bunch of other things. But you cannot say that I'm going to be an idiot and I will continue to be an idiot and somehow I should. So as somebody said, the law is to protect the, what is it? I forget the word now what it was, but not the stupid, okay? You cannot literally pretend that it's not up to you to understand a little bit.
No, so I'm personally, we are big proponents of that. If it's not in writing, if it's not on a recorded channel, then don't think of it as a promise. Then it's just a vague assumption and that you can completely ignore that. So I think, in fact, I think that in itself just adhering to that, just one simple hack, if someone has to take away, is that whatever they are telling you on your face, ask them to send it on a written channel on the company email address. And if they don't do that, don't buy the product.
I absolutely agree.
That itself takes away, like 90% of all the kind of, all the mumbo jumbo. I mean, this goes back to when I was young. I used to hear this 15% to mili jayega. I mean, people used to say it like you the guarantee hai. But it's framed in such a way. They're not used the word guarantee. They've not written it on a piece of paper, but the way they've said it, it's unambiguous to the other person. Yeah, okay, 15% is the minimum I should expect. And I think writing it down, making it an explicitly as a promise definitely changes that. What else can we do, Jency? I mean, is there something where, how can social media actually help increase this kind of awareness?
Well, I have a very
or hurt. Maybe.
I have a very radical view about social media and
Right.
investing and putting your money when it comes to information. I'm quite an old school that way.
Right.
Like, for example, I don't trust my money with anything beyond what I would have seen it myself. Like, for example, coming back to the topic that you all were discussing earlier. So if we are not irrational, then it assumes that you have to burn your own money before you learn how to make money out of that. I'm just leaving that thought. Probably I would like to hear from both of you.
No, but you can learn from other people's mistakes also. No? See, I don't have to crash a car to realize it is a 4-star crash rating. I can just learn from.
Yeah, but
I'm totally fine with making mistakes, but I'm not fine with making all the mistakes. Right?
That may not be a fair analogy, because you get the license to drive a car only after someone has checked whether you can drive that car or not. That does not happen when it is managing your own finances. Let's just think about it. Someone who probably gets a job at the age of 21, 22 and have gone through the same school and college education system where no one has taught them anything about how to manage your money. What do? I mean, either ways, people either blow up their money and live the good life, or by the time they realize and someone says, okay, put money here, put in SIP, put in fixed deposits, or put in stock markets, there is an element of risk which is involved where they end up losing money before they come to the cycle where they understand, okay, this is what I was doing wrong and let me do it differently. But anyways, coming back to your original question, when it comes to social media, when it comes to probably getting advices online, I have built very strict parameters for myself how I'm going to put my money. So I've obviously learned it over the period of time, but otherwise, any advices that I get, I'm on so many market groups, just by virtue of being a journalist. One thing that you always need to learn is that if someone is telling you that they are making money out of a certain stock or a certain product, obviously that has already been priced in. By the time you get in, you have already gotten at the top and you're not going to make any money. So the broad sense that I get from this is that, yes, ask for all the data that you're talking about. You don't just look at 1 month return or 3 month return or 6 month return. Look for a longer return. I can show you funds which have come into the market in 95 and 2000 and 2005 and have just not given any returns in the last 3 to 5 years. I feel that over a period of time, someone is going to break this myth of SIPs being an all-encompassing wealth generator at some point of time, because just by being in the industry for about 20 years, a fund necessarily need not give you the return that probably you're looking for. So I would say that don't always look for things on social media. There are many people I've seen on Twitter who say that, okay, follow my handle and I will tell you how to make money. It's a sure shot, disaster that you're going to fall into. Or probably someone telling you that join this WhatsApp group, every day morning they will give you a stock tip and then you will be able to put in your money. Just
like hot tips are a complete no-no, basically.
Yeah, unless you understand the stock markets, don't get into equity. Stick to SIPs and stick to mutual funds, because someone else is doing the thinking for you.
I disagree. I think there's a bunch of Jency, there are two different aspects to it. One is losing money because of mis-selling, when there's something wrong with the product or highly priced, high commission, whatever, right? And then there is markets can actually be flat or down over 20 years as well. Okay, look at Japan. So I'm just saying to you that just because someone has lost money doesn't mean they were missold. Okay, they could have been they could have bought something overpriced. So I'm just saying there are two different aspects, which is why I'm saying to you that I think I'm also trying to use social media to reach people. If people followed your logic, then they would discount me as well, which is not
But
fair.
are you selling a certain stock? Are you saying that investors?
No, I'm not.
Yes, that's exactly what I'm saying.
I know. I'm saying to you that there are a bunch of people I've seen on YouTube who sound very similar to me. They also say, follow us and we're giving you financial education. I'm also saying that. I'm quite aware that it's ironic that I sound pretty much like the same people that I'm trying to warn them against. Okay, so I am quite aware of this. And hence I'm saying to you that I don't think it's fair to say a blanket statement, everything on social media is not worth following. I think that's not true. I think there's some amazing people on Twitter. I only go to Twitter to follow some amazing people who talk a lot of sense. Okay, so I think you need to do a little bit of research to find who the people are to follow. And yes, it's worthwhile finding a bit more about what they have done, whether they had incredible jobs, what their qualifications are. I think a whole bunch of things. So I think the medium, being social media or traditional media, is not the culprit.
But Hansi, I would draw a line
the underlying person.
If I'm selling a product, if I'm saying that, put your money in this product, I need to know as an investor, what is the underlying interest that person has in pushing that product. I'm differentiating between the product and the team.
Agree. So I'm saying to you that therefore the medium, being social versus traditional media, is not the culprit. Okay, so you have to, just like you would do some due diligence on a real person when you met them, you do them on social media also, you do them on traditional media also. So I'm saying to you, the medium is not the culprit. So that's one. Two, coming back to your point about the driver is tested. The driver is tested not because they will kill themselves. That's the easy part. If there was just that, they wouldn't be tested. The reason they're tested is because they might kill somebody else. So that analogy, because if you are a financial advisor and you can cause damage to somebody else, is when you are tested. And to be fair to SEBI, at least, they are putting higher and higher standards in to actually say, thou shalt have a post-grad qualification. In fact, right nowadays, to become a RIA, registered investment advisor, you have to be post-grad. So a bunch of my friends can't even apply, which is quite ironic.
It's got much better than earlier.
I know, so I think that's good. It's just that not all financial products are regulated by SEBI. And SEBI is doing it also slowly, right? One fine day, 20 years ago, they couldn't have done it, right? So they had to match their pace with the market, where the market is at. If they, in fact, already their requirement are so high that there's not enough advisors in the market to cater to everyone, which is why something like a Kuvera or other platforms or my platform needs to be there. You cannot say that just because I'm using a digital medium, that means I'm bad. I think we are all trying to educate the market, but because you're putting it out in the social media domain and on a website, I'm open challenge. If anyone can find anything wrong in what I have said, my career should be over because you will call me out, right?
Exactly,
so I'm putting my reputation on the line. So I think you should follow, at least check if it's a real person. If they're hiding behind a corporate handle, then yes, then that's the one you should question. But if they have a real name,
it doesn't even have to be that, right? I mean, see, so going back to Jency, and how we think about this is, right? When you do something on social media, so there are two different aspects to it, and I think I spoke about it a little bit earlier, right? There are closed groups and open groups, right? If it's happening on WhatsApp, then it's not that auditable. That's why advice you get on WhatsApp, hot tips you get on WhatsApp, you should stay away from them. Telegram, same difference, doesn't make any difference, right? But then there are public platforms, right? So it's like the platform she runs, the platform we run, right? We actually believe that one of our biggest strengths is literally that everything we do is done in the public domain. If we make an error, right? If we make an error of judgment, if we make an error of framing, if we make an error of just representation, we have hundreds of thousands of users. Someone will catch it. And they'll come back to us and they'll say, you know what, if you don't fix this, I'm going to go to social media, right? So you better fix it, right? So effectively, when we think of our business, we are like, you know what, if someone is on a platform like ours, if someone goes to a platform like Hansi, the smartest users in our cohort is watching out. The most financially literate users in our cohort, they are watching out for the interests of everyone, right? So in a way, technology here is making the audit process that we talked about, right? Is that advice auditable? Which is kind of why the biggest hack is give it to me in writing. They won't give it to you in writing because they don't want to leave an audit trail. Otherwise, it just becomes I said, he said, right? Okay, yeah. No, I didn't, I never said that, or I said something else and you misconstrued it as something, and then it. So so I kind of agree with I think what Hansi is saying, that technology, we can't just kind of blanket blame technology or social media. But I also agree to Jency's point that in social media, still if it's a closed group, and that's why you will also see very particularly, right? If you look at all these hot stock tippers, right? It always says join my WhatsApp group, join my Telegram group. Why don't they say join my Twitter handle and I'll give you, because Twitter is auditable. Why don't they say, join my Facebook group? They always pick a platform where they have deniability, first of all, and second is that they can hide behind being they don't have to disclose who they really are.
Yeah.
But Gaurav,
Again,
I also feel that this is not always the problem of they're not always hiding behind encryption. For example, I worked for several years in business news channels, and I still have a problem with that model, where
Right.
someone stands up and says, okay, breaking news of the day, I've got this news about this stock, and invariably, because I've worked in the back end, I know how that system works. It is not as if they're out there to pull a fraud on their viewers, but invariably most of them are not being true to the job that they have been interested in, and the kind of trust that I think people today have figured out.
How do you solve for that? I mean, you're talking about, are you talking about like pump and dump schemes, or kind of pump and dump schemes?
No,
I'm not sure. Maybe I'm putting words in your mouth.
No, someone someone will say, okay, so probably this is what the announcement which we are hearing from our sources about this stock, and suddenly you see the stock running, right? Now, I do know how that works, because many of those analysts are part of these same WhatsApp groups where there are brokers and traders who are part of it. And they are trying to push the stock, and they're pushing the stock to these analysts who are out there on the screen. Either they are your own employees, the business channel employees, or they are probably analysts who are coming in and recommending the, A stock or B stock. There is invariably a lot of risk that is involved in it. And is that mis-selling? Like one might say, okay, if you're putting your money in the stock market, you are gambling with your money in some form or the other. There are many people who tell me this. I mean, I'm a stock market investor.
But shouldn't the journalistic standards not allow something like this to ever get published?
Well,
but Gaurav, I'm sorry, journalists think they're financial analysts. They are not. So
they're not. Exactly.
Who
that
should
is the point I'm making.
Finance news anyway? Why are they listening to finance news?
That is the point I'm making. That
they're journalists. They're not analysts.
Someone is trying to rig that stock price, and that stock price is being rigged through people who are saying that I have heard this news that sources are telling me. And I'm telling you again, no research has been done on this. But if someone goes and picks up all the stock market recommendations that have been done on these channels over the last 6 months or probably 1 year, you will find that invariably people have lost money. There will be some stocks which will be multi-baggers, all of that.
How can cross-checkers, how can cross-checkers like you come into this picture? I mean, how can we solve for this?
Yeah,
I mean, is there
just on that point, I would say is that I think it's what he's raising is fair, but I think it's a very, very small part of the population. So I think we're getting catering to that 1-2% of the population that wants to play and gamble in the stock market, who don't know any better. I think.
But Hansi, I agree with you. But let me tell you why this is dangerous. When people lose money in the market, they go and badmouth the market outside. They'll say, okay, I didn't make money in an SIP because X, Y, or Z said it and I did not make money. There is a ripple down effect. There are a huge set of population of people who probably could benefit from better savings, better investment modules, like putting in money in some good mutual funds, by putting in money in equity, but they don't do it because they are relying on the bad experiences of others who have relied on people who have, I don't know whether you'll call it mis-selling, but who have gone and misled people into investing into stocks and have painted a rosy picture rather than telling them and that's the problem of running a 24-hour news channel.
What I'm saying is that the journalists are not experts. I'm saying to you, journalists are journalists. It's their job to report what somebody else has said. So I don't know that we should go about fixing. I mean, that this is a global phenomenon. Media exists to amplify news that the companies have put out. Okay, so that's how markets work. If there is some market sensitive information that the company wants to announce, how do they reach everyone in the world? They go and put it onto a television channel. So I'm saying to you that television channels have a purpose. The purpose is to amplify news that's coming out. It's they think that their job is also to go and rate mutual funds and also to give buy sell recommendations on stocks. Who gave them that job, and why the regulators are not stepping in to say, hang on, are you financial analysts? Are you even qualified?
Yeah.
Should you be doing that?
That's
and they
exactly.
try to walk that fine line, and they try to, sometimes they hide behind somebody else said, so-and-so said that. But there are newspapers that give fund ratings. Now, that's not a regulated activity, but it should be.
The first time I'm hearing which newspaper gives fund rating on.
Everyone does it. Ratings, rankings, whatever they call it. Star.
Yeah.
I mean, they hide behind that. Sometimes they take up Morning Star.
Rankings maybe, because ratings,
And then
I
they
think,
say-
is a defined word.
And then they say, ये 5-star rating लिया है मैंने. उसके बाद मैंने जो है, we've gone and done qualitative analysis over and above that. I know, but if qualitative analysis was that easy, why did I go and do a CFA and spend 20 years doing it for an institutional investor? If everybody could just do it. So I'm saying to you that the public relying on journalists, I have a lot of respect for journalists. Okay, I want to be one. I am becoming one by launching my own platform. Okay, but there are two different hats that I would wear. I think a financial analyst, a CFA, for example, I'm a CFA. I've been 20 years a CFA. If I am caught, any of my peers can report me. If I do, forget an illegal thing, if I do an unethical thing, which is legal but unethical, any one of my peers can report me and my CFA would be stripped. Okay, so that's the standard that I'm being held to. And I think more people, CAs are held to a standard, CFAs are held to a standard. So if you are going to take financial advice, please take it from someone who's qualified, who has a reputation to lose, who has a career to lose. Journalists have a different role. Just be very clear. And again, I'm saying to you, you cannot be an adult, a person of the world, and claim that you don't know that journalists are not financial experts. I'm sorry, do you not know what professions mean? I mean, surely.
So I think just to kind of wrap it up a little bit, right? So a couple of things came out. So I think one of the big thing is that misselling will happen. It is up to the individual to prepare for it. Don't expect the state or the media or anyone else to come in for your defense. So learn a little bit about finance. That's a good thing. Second is understand who you're getting advice from. So not all advice is equal. If it's a hot tip on a WhatsApp channel, then it's a very different advice than if it's a long form or if it's a well-reasoned, well thought of advice from someone who has had a career in finance or who understands investing. So make that. Third is that use simple hacks. The most important hack is before you sign off on any product, just make sure that everything you've been promised is given in writing. And I think that alone is, by the way, solves a lot of this. Technology can help, technology can hurt. So use technology in a way that it helps you making better financial decisions and not drags you into this stock is going to double tomorrow. So is that a fair assessment of kind of some of the different views we have discussed?
Yeah, just one thing I'd say is that I wouldn't put the onus just on the investor, even though I was the one leaning towards saying you have to be well informed. I'd say there is effort being made throughout the world for it to be on both sides, buyer beware and seller beware. Okay, so there is regulation
to maintain, to kind of even the playing field for both of them.
Yeah.
But I mean, at any given point in time, right? I mean, you have to always guard for your interests, right? That goes without saying. If you get regulatory help, great. But even if you don't, so that was fantastic. I think it was a great conversation. Thanks, Jency. Thanks, Hansi. I think we really went over above our time, but I had a lot of fun. I think it was two very passionate people talking about things that are close to them. So thanks so much for coming on our show.